Well, I think we'll just get going. I don't know that there's somebody from Amplio that's supposed to start me off, so I'll just get started because I think we're past time. So the discussion here is going to be about accessing the debt capital markets, the various pockets of debt capital that are available, and thinking about your capital structure and optimizing your capital structure. And so I'll start off with a quick background on me. Right out of school, I went into investment banking, did that for 6 years, worked within some Fortune 500s within finance departments as well. And then I was the CFO of a couple of venture-backed startups and was able to be a part of helping grow and then sell those to public companies. And then joined or purchased from its founder the firm that I run now called Economics Partners, that we do business valuations, business appraisals. But as a CFO of both Orange Soda, which was an online marketing business down in American Fork, and then Goal Zero, which was battery packs and solar panels for campers and backpackers and that sort of thing. In both of those instances, debt saved our bacon. And I lived in a world amongst entrepreneurs that most of them only thought about equity for the most part, as, oh, we need money, so we need to go out and raise capital. Let's go out and raise an equity capital round. And when we were at Orange Soda, it was a term loan from Bridge Bank that saved our bacon, that if not for that term loan, we would have gone under. And it was really cool. Bridge banks would sort of go through everything in detail with us, get comfortable with the turnaround plan, extend a bridge loan to us, and it saved us, and we ended up having a successful exit. And then we got at Goal Zero, it was a large credit facility that if not for that, we would have been in a bad way. And in that instance, both Wells Fargo and SVB stepped up. And I won't say which one we went with because both are here and I love them both. But anyway, so I'm a big believer in debt, and because I had experienced it as an investment banker, I was kind of aware of the various pockets of capital that are out there. But I think there's a decent number of executives, not necessarily finance executives, but certainly some that might have more of an accounting background and less of a capital markets background, that don't know the debt capital markets as well as maybe they could to take full advantage of what's out there. So the goal here is to educate a little bit on that. So that's sort of my testimonial of debt. And so we'll talk a little bit about, from a capital market standpoint, you can go from equity, it's your most expensive capital, all the way down to sort of personal guarantee debt that is you can get it that is pretty cheap debt. So we'll have our panelists introduce themselves, and they represent various pockets of capital, or in Ted's instance, he helps broker accessing the pockets of capital. And so I'd love for them to introduce themselves and talk a little bit about the trends that they might be seeing, and some of what their respective institutions do. So maybe Riley, can we start with you? Sure. Yep.
My name is Riley Rispo. I'm with Gulf Coast Small Business Lending. We're a bank lender out of Texas. We're part of a larger bank holding company called Gulf Coast Bank out of New Orleans. And we were purchased about 6 years ago to be the bank's SBA department, essentially. We run pretty independently from the bank, and we have separate headquarters, like I said, in Dallas. But I operate in Heber City, Utah, and I live up there and just work remotely. And our specialty, again, is SBA. We mostly focus on 7(a) products. We can offer 504, which is the real estate SBA product. And then we also offer the USDA rural lending for small business and industry program. I've been in SBA for a long time, been in finance for 26 years, and the trends, I guess if I'm going to point to one trend that I'm seeing a lot in the SBA, kind of the smaller tier, small business world, is there's a lot of opportunity created by external circumstances right now. So with COVID, we were kind of, especially in the small business world, the M&A cycles kind of hit that high valuation that I guess you would hit the cycle that cycle, and what COVID and other circumstances have done is kind of brought that back down, and so there's bargain hunters out there picking up good business models that have been hammered by COVID and other circumstances, and so we've been very busy, very active in helping people acquire businesses, take out competitors, buy out partners who are just kind of done with the grind, but you've got an existing partner who wants to keep going forward. So that's what I'm seeing trends in my life.
And it's funny, from having been in investment banking, I was aware of some of these pockets of capital. I didn't know 7A lending. When my business partner and I bought this business, a competitor called me the next day and said, hey, I'm actually selling my business as well. Would you want to buy it and put them together? I was like, I'm tapped out. I just spent my life savings on buying this business. So no, and the pockets of debt capital that I know of, I didn't think I could pull that off. And I wish I'd known about 7A. I could have bought them and I wouldn't be competing against them to this day. So.
Hi, I'm Kirk Hayes. I'm the president and CEO of Tap Bank. We're located up in Ogden. We've been in Ogden for 23 years, but not a household name because we've operated over the internet and digitally for all 23 years. So we have no branches. You can't come deposit a check in our office. We do everything digitally, so over the internet, and really more and more even on the corporate side from a cell phone. We're a leveraged finance shop, so most of our credit goes to businesses to help them for acquisitions, ownership turnover, growth, cyclical industries. We help companies get out of excessive leverage, traps, etc. And so we play in the capital stack pretty closely under NASDAQ, etc. As a leveraged lender. I assume that the audience in this room, you came to this session, you're not representing looking for strong companies that have excess cash flow, lots of liquidity, and low leverage, and you'd be in one of the other panels. So as you're going out and what we're seeing, and today the trends for us, we're a $1 billion bank, so we actually have credit products for business that goes small as $50,000, but we go up to probably 10 to 15 as our top size of credit. But what we're seeing today, the trends are, it's just, as was mentioned, it's just a ton of liquidity out there. Easiest time ever to get credit. A lot of it because of excess liquidity, which we all know because of the stimulus, et cetera, that's in the economy. There's another factor that's happening here, and the access to credit is expanding anyway with the technology. You can go online now, and if you Google search for any type of credit, you will get bombarded by purposeful digital lending companies that have bought the real estate in the first couple pages of Google searches. And so, that world is out there, and today now choosing, finding credit access is much easier than driving to a bunch of bank branches and finding somebody that can help you out, or finding somebody at a church or country club that you can build a relationship with. The types of credit available and the cost and availability are like it's never been before. So there's a confluence of factors, and it's not just excess liquidity in the system. The risk out there, I think, is finding the right match and finding the right credit partner. And again, that's something that I think CFOs in the world need to be more cognizant of really what's going on and who they're partnering with. We see, because we work in highly stressed companies mostly, we see a lot of MCA lenders. If you're not familiar with lenders that come off credit card receipts and they will lend money, in hours or minutes. You can get access to easy, expensive, and dangerous credit because it's so easy to get. Businesses are just like teenagers. If you give them too much, they're going to take it. If you give too much, they're going to So, that's kind of what we're seeing out there. We go in to help viable businesses. We go through corporate underwriting. We get a deal approved, and all of a sudden we find out through UCC searches that there's 3 or 4 MCA lenders stacked up behind their senior lenders. So there's a thing that's happening out there is kind of the wild, wild west of credit availability that can be very confusing and overwhelming. And I think it's really incumbent on professionals, advisors, the CFOs of the world to go out there and really understand who you're doing business with. And so For TAB, we're very proud of the fact that even though we're digital and I think 7 or 8% of our customers are actually in Utah, we run all over the country. So we have a very loyal customer base, and we've done it through digital, and that's because we've armed our people with technology. So we have very strong connections, even though we've never met face-to-face with our customers. And so we have net promoter scores, customer satisfaction scores that are near the top of the industry, and we've done it digitally. And so for us, it's a deep partnership. We want to provide certainty of credit and availability and quick access to it. And as a CFO, those things are valuable. We play I think a solid part of our capital space. I'll stop there.
Ted? Yeah, Ted Gibbon, managing partner of Capital Pro Partners. Recognize a lot of familiar faces here. I was in banking before at Wells Fargo and KeyBank for a long time. Commercial banking. Broke off about 5-6 years ago. Started a company that brokers commercial loans, so all we are focused on is debt. And we work with any type of lender out there. So even though your bank might say no to you, there's definitely sources of capital for every situation out there. So we're kind of the matchmaker, like Mitch was saying. We help companies through the process. We know what lenders are doing. We work with all types of loans, real estate, equipment, any type of capital out there. So we understand what lenders are doing, where rates should be, where the best source of capital is. So we work with every one of these lenders here, and so we try to understand the market and help our clients through that process, because generally they only go through it maybe once or twice a year. As a CFO, they're going out and finding a loan or raising capital, and we work with hundreds of clients and hundreds of banks out there. So that's kind of what we do, and we try to be experts on all types of loans. So, thanks.
Great. Good morning, everybody. My name is Rich Lambert. I am a commercial banking leader with Wells Fargo Bank here in Salt Lake City, Utah. I've been actually working at Wells Fargo for about 28 years. And so when I started, I had a lot more color in my hair, and frankly, I had more hair. But it's been a wild ride. It's fun to see everybody here today. I recognize a number of you from working with folks in the market over this time, and it's a great place to be, and I truly love what I do. But I manage a group of commercial bankers in Utah that covers the middle market space, which is, the way Wells Fargo defines it is companies over generally 25 million in annual revenues, upwards of 3 billion. So this is a little bit more of the established market, more of the traditional banking market than maybe what we've heard about. And I would say that we fall in line with what many consider to be the pro rata market from a debt capital market standpoint. So our funding is just traditional commercial banking. It's what we focus on are companies with a good established track record, historical ability to be able to provide a source of repayment for their debt obligations. We're not interested in startups. There's other opportunities to be able to fund that, and I think that we've talked about a couple of those this morning. We're going to be more conservative, but we're also going to be probably your cheapest capital source, frankly. And so as companies that are established, they're looking to grow their business, they're using us as their primary source of capital. In fact, many of our companies that we lend into, we actually have more invested in their business than the owners themselves. And that's not uncommon. And I think that where we play well is just trying to make sure we've identified those businesses. In our line of business, we can't be wrong too many times, and so we often get chided for only lending to companies that don't need money. It's kind of a funny irony there, but if you think about it, the model that we play is we lend money that has been deposited into our institution by your grandma in their checking account. And the last thing we want to do is have grandma show up to her checking account and realize there's nothing there, and that would be an insolvent bank. And so we have to be very careful with who we lend our money to, and to make sure that we can get repaid back. But the flip side of that is we typically are able to provide a good pricing and a longer-term relationship. And so I think where we play, we want to make sure that The typical structure that we typically lend into is where we have a primary source of repayment, which is first and foremost the ability to be able to get repaid from cash flow from operations of the business. And the second would be a secondary source of repayment, which is typically the ability to be able to go out and liquidate margin collateral. We're not typically taking airball loans. We will do them on occasion. There's certain exceptions to that. But we're primarily focused on deals that have a good solid primary source and a secondary source of repayment. Some of the trends that we see in our space are interesting. We lend in a very mature market. It's very established. We compete against all the major players, even globally. And I think where we sit today in the market, in that pro rata debt market, is there's a strong willingness to lend right now. And I think it's a good time to borrow, but it's not a crazy time to borrow. I would say, having done this for 28 years, I can tell you a number of periods in the economic cycle where things have gotten a little bit out of control. We're definitely not in that cycle. I think there's a fair amount of discipline around how banks are lending right now, and it stems a lot from the regulatory tide that happened after the last economic downturn. And so what we see right now is competitive pricing, and the pricing is being driven by a couple of things, and Kurt kind of alluded to a few things, but the liquidity in the market has really driven up bank deposit balances. And those deposit balances need to get deployed. That's a liability on a balance sheet of a bank. That needs to get put into the market and lent so that we can get a return back and pay grandma her interest, even though it's pretty minimal. But there's so much in the market right now that's been deposited into banks that the willingness to pay up for those deposits has been contracted to a large degree. And banks are really actually not looking to take deposits on right now, frankly. And so that's driven a willingness to lend and to lend at competitive rates, maybe even more competitive than in some historical cycles, and certainly a lot more competitive than where we were a year ago. A year ago, everything was in flux, and everybody was trying to get their head around the impact of the pandemic, and we've seen the rate cycle settle back. What we haven't seen in this cycle, and I think is a good thing, is there hasn't really been a lot of what I would say loose competitive structures being given in the market. And by structure, I mean, covenants, willingness to lend at high leverage points, at least in the traditional banking sector. It impacts me. Yeah. Anybody who's really trying to lever up their portfolio, the banks are largely staying fairly disciplined and not really in the pro rata market, not going above 3 times leverage, 3.5 times. There's exceptions to that, certainly. But the closer you get to that 3 times leverage mark, the tighter the structure is going to be. And that may require guarantees and so on and so forth. So it's a good time to borrow, but I wouldn't be expecting to get a lot of airball financing and high leverage points compared to maybe where we've seen in times past.
Yeah, I was at Wachovia representing KKR when we were going after a textbook business, and they wanted 10 times leverage for that deal, and we were super conservative and stayed at 8.5 times leverage. And Apex Partners got a 10x leverage deal, won the asset, and then went to sell the term loan B, and it was the first, wanted just completely crater. And that was when the entire city of Charlotte knew the music had stopped, so we couldn't sell our house at that point because everybody was the music just stopped. And so, anyway.
Hey, Trent, on that note, though, I would say that the ability to be able to get financing after that, 8 times leverage position can still exist. We're not really seeing it even from a junior debt perspective, but there is junior capital out there that's willing to go and add another couple of turns of leverage onto a deal. But we'll only take a senior secured position up to kind of that 3 times range.
Yep, makes sense.
But I'll add to that too. I mean, that's middle market, right? In the lower end of things, you can find plenty of leverage. You're not going to get 2.5%, 3% rates on it, but the capital's out there, and I think that's the point of this panel, is to show the full stack is out there. It's good.
And so in that vein, we've got people here that might be with, somebody that's, with going out looking buying a competitor that an SDA 7A loan would be perfect because it's a little $5 million acquisition. How do finance professionals like hone in on the right capital roadmap for their company? So not only how do I find the right pocket of capital for me and map out what I should do, but also thinking about, like at Wachovia, we used to provide for our clients debt comps. And so you'd say, hey, here's all the other people in your industry and how they're capitalized, but we've got public reporting to help us do that. How does somebody in a private company potentially figure out what is my correct capital strategy? Who should they be talking with, and how do they research that, and how do they figure it out?
Sorry to cut you off. I'll yield here. But I would say that first talk to your banker. I mean, I think at any institution, frankly, they're going to be able to provide a fairly good indication of what banking channels and financing channels can provide. But you know, you talk to Ted, and Ted's a broker, right? He'll have a wide arrangement of options. I would also say, talking with the folks at Amplio, they do a great job putting together this conference here. With their outside CFO sourcing, they have a wide array of understanding of some of these opportunities and different COIs within your centers of influence within your business organization. So your attorneys and CPAs can also provide some guidance. But I would say that you know, your banker should know that. And if they're not providing you some of those ideas, you might want to be looking at other bankers.
And Ted, when should people come, like, so we have a client that just ran a process with one of the bigger investment banks that's more advisory, not lending, just helping them run a process that I think they approached. You know, it was dozens and dozens of potential lenders, which I know the lenders don't like being in a bake-off process. But how do they decide, I should go get a debt broker, and how do they decide, like, I should be using one of those big debt? I mean, how big of deals can you do, and how does somebody like decide who they should be going to as a business broker standpoint, or a debt broker standpoint?
Yeah, I think once you get above a certain level, you know, there's more debt out there, like sub-debt that Rich was talking about. But kind of my area, we do a lot with SBA, we do a lot with maybe under 20 million in acquisition. So usually we'll look at the company, and you know, the bankers look at it one way, and there's other debt out there. So there's other options. There's sub-debt. There's
you don't go to like if Wells Fargo are going to do a pro rata 3x senior facility, they're not going to help fill out the rest of that capital stack for you. You got to go out and find it. So if you're looking to borrow more than 20 or 50 million, is that when you start talking to I don't know, Julian Loki, or to like who do you go to figure out if I want to run a process, find the right credit for me?
Yeah, so if you're capped out at the bank debt 3 times leverage, there are mezz lenders that will go above that. You know, so I think.
Do you help find the entire stack? Like if they were going to have a couple of, they're going to have some mezz, like you're helping put all of that in place?
Yeah, we can help with all that. You know, yeah, we work with a lot of mezz lenders. We work with private lenders as well that can kind of add.
Yeah. And to the lenders, do you guys have like your go-to, like, hey, we can do this, and I would refer you to these guys for that, or you don't do that, or how does that work?
Yeah, we do, and part of our network, because we're not a geographically based organization, our network depends on people like Ted, it depends on advisors, mezz lenders, private equity firms, and all the players that are involved in that leverage space. And so, you know, we maintain a network of contacts. I think the most important thing for us, and we've seen that, I've seen evidence of this. I've been in banking for 40 years. I've been doing leverage finance for probably half that at least. And right now it's going to be ubiquitous. So, you know, people can get credit with interest rates low, liquidity, so, you know, you can qualify. Notwithstanding, you know, that you need to be top tier cash flow, et cetera, and balance sheet to be able to maybe go with the Wells or one of the top 5 banks. Beyond that, it's all accessible. The trick is what's right, and I think there's been historically a chase for the lowest yield for credit. And I think I've seen a trend now with broader availability and options out there for people to start weighing their partner. You know, if you listen to the discussion that Gary was making this morning about what the scenario 5 years forward was just frightening the Jesus out of me just listening to him talk about this. But that's a scenario your debt structure needs to meet. Tyler, you know, one of the founders of Every was just, you know, in a previous session talked about, you know, kind of matching things and knowing where you're going. A lot of CFOs, you know, look at dashboards. Well, this is where we are, and this is what we performed the last 9 months. Just as much as anything, the debt stack, the capital stack needs to suit you for the next 5 years. So what are the scenarios? I mean, one of the simplest things which I scratch my head at right now is there's very little discussion about stress testing for higher interest rates in when you're doing capital planning and such. And I don't know why. I've been through this, you know, lots of cycles, and you know, it is going to happen at some point, right? And so we should be prepared for it. How does that capital stack, how does your debt behave at higher interest rates? But also the covenants, right? And the structure. Is it going to suit me when things are stressed? I think those are some of the most important things. And then, you know, there's a groundswell with the concept of systems thinking that's really important today. And I think we see in the supply chain mess we're all dealing with today, there's shortages of all kinds of things. And all of a sudden, CFOs are waking up to the fact that my vendor relationships are as important to me as anything else. I don't need to drive, and in Walmart, we saw them, you know, 15 years ago go through this learning curve as well. They were squeezing every penny out of their supply chain until they broke it. And then they realized, well, I need to take better care of our suppliers, or we're never going to be around to continue to supply. That kind of systems thinking is now critical, I think, when you're planning capital stack leverage is, you know, what happens not just to my vendor relationships, what happens to my capital stack when things get stressed. Am I with a lender that understands me? Do I have mezz players in it that are going to play nice with my senior lenders? Do I have a private equity firm that's going to be a partner? All of those things, depending on your particular situation, it's no longer about here's a term sheet on how much that's going to cost me. I think you really need to spend a lot of time thinking about all the interrelation between all the systems. There's a guy named Simon Wardley in the UK. He does this thing called Wardley Maps. So he takes any business, any situation, and he puts it on a 3D kind of visualization map. And you can see very easily when he's finished how different things are interconnected that you had no idea were interconnected. If you have the wrong capital stack for a stress situation, it's not going to work. And when's the worst time to look for new capital? When the environment's bad. And so as things cycle the other way, right, that's what we should be preparing for. I think you can find a capital stack to match just about any situation today based upon performance up to you know, whatever today's date is. Find the right capital stack for 2 to 3 years in the future that's going to suit you. Your certainty, transparency, and fairness. That's, I think, the top 3.
So I think a lot of people steer toward equity because they think, well, I'm not as stable as I'd like to be, and so equity, you know, is my most expensive capital, but I also don't have covenants that I'm dealing with. You just talked about when people are in a stressed situation. Anybody want to kind of address Riley all the way up to Wells? You know, when the company doesn't perform
comment about the prior availability of capital and how do you know who to go for, or go with, and where to find these different pockets of debt. I guess there's some concurrence, I'd say, but I'll also say there's like so much incestuous stuff going on between the bankers. Like, we're always trading deals, and if someone comes to me and says, you know, this is what I need, it just doesn't fit my niche that I'm working in, I've got, you know, multiple people that I can send them to, these guys included. So the debt is definitely out there if you want it, whether it's on the terms you want or not. That's, you know, that's another story. But there's so much available.
Yeah, I think, you know, we have a product that sits right outside of the 7A product, and we basically partner with a fintech company that sources 7A loans for banks across the country. And so we sit next to that, and then anybody that gets rejected for technical reasons for a 7A loan, we have a product that it's not as, the 7A product's a fantastic product, it's one of the best out there. But it also comes with, you know, tying up all collateral guarantees, requirements that can be cumbersome for a fast-growing or dynamic company as they kind of go. So, you know, people make decisions or they might technically not qualify as they go through a 7A process. Again, to that access, so we have a term loan. What's the current rates for 7A?
I mean, it's the whole spectrum. We play in the whole coupon. The top end is 6%.
6%. Our term loan product is about 15%. So that sounds horrible, right? If you're an entrepreneur and you need money now, that 7A process not to put you in a spot for what, a couple, 6 weeks?
Yeah.
So, you know, you can get a loan the next day for this term product. 5-year repayment. We do have personal guarantees, no covenants, no collateral. So, you know, it's a streamlined shot to get that.
Deal would that be?
That only goes up to 500,000, so it's a little tiny shot of capital, right? That we do. So, and then we have a factoring product. If you need $10 million or $15 million, you have the accounts receivable, you can go and get that with limited, no covenants on that product as well. So, the gamut is out there, and I think it's incumbent to figure out stable companies that have good growth, et cetera. 7A is just one of the best things out there. I mean, it's the most cost-effective ways to access capital. It's just not, you know, qualifying for it isn't a dumb luck by any means. So, if I strongly recommend that, you know, the advisors in this room, outside advisors, really have a value add today. And I might not have said the same thing 10 years ago about outside advisors. So there's, again, so much out there, finding the right fit is hard.
Maybe just address covenants quickly, and then I want to jump to another topic. So somebody trips a covenant with a you know, pro-rata loan with Wells Fargo. What happens then?
Yeah, I think it's a good question. What I would say is really, first and foremost, try to understand your situation. Understand what puts you in a position where you essentially tripped your covenant. Bringing an understanding of the dynamics in your business to why you actually had that event happen is key in being able to communicate to the bank and really come up with a roadmap on returning it back into compliance. I'll tell you a couple of things, maybe a couple of tricks that I've learned over the years. First and foremost, communication is key. Just be completely transparent and open. If it looks like you're trying to hide something, and even if you don't understand, just say, listen, we don't understand, we've discovered this item, we're digging into it, we'll have an answer to you in the next 5 days. That's great, your banker will actually really appreciate that. It's when the banker finds out about it, and you haven't even brought it to their attention, that things start to get weird. And at that point, the bank starts to go into defense mode. And your ability to be able to influence how the bank reacts to that is entirely indicative on your communication level. So that would be the first thing. The second thing is involve your owners. I know there's a lot of CFOs, controllers in this group that have the autonomy to be able to make capital decisions and to be able to make decisions around how the banking relationships are handled. The problem with that is that if for some time, if you have to restructure a deal, at the end of the day, it may require that owner to be engaged. And if you've really had a large event of default that may require restructuring your deal, the owner may be on the line for a guarantee in the bank's mind, and the first time they find out about that is in your fourth conversation. It's going to be a little bit uncomfortable for everybody. And so I think bringing everybody together and have just a forthright conversation with the bank is important. What I'd also tell you is this: the bank isn't looking to try to go out and put people into default. Covenants, you get tripped all the time. I mean, if you are 2 days late in your financial reporting on your monthly financial statements, you're technically out of compliance. We don't throw the book at you for that. You may even trip a financial covenant that's got some meaningful ramifications, but it could be a very explainable situation. These things, we work through these things all the time. It's very rare that you're going to get the worst look at the bank right out of the gate. So you have the ability to be able to influence that with your conversations and just being transparent. And you'll find that the bank is really trying to work with you, because the last thing the bank wants to do is basically take over your business. I mean, I don't know how to run these businesses. And I rely on the experts that know their companies, know their industries. We want to make it work. We want to get repaid back. And the best way we found is to be able to work closely with the company to see that happen. If for some reason it's gotten to the point to where it appears to be potentially a threat to the investment that the bank has put into the business, and the bank is worried about being able to get repaid back, that would go to our workout group. And the workout groups, their focus is going to be, at that point, shifts to entirely preserving the asset of the bank. And so that's where conversations get a little bit more stringent. Your buddy banker who you've been golfing with, the new guy is not going to be as interested in making that golfing habit. He's going to be more interested in saying, okay, really, what are you doing? What's your cash projection? What are you looking to do to get your business recapitalized? Or the outside investors? Or, is there money that the owners can bring to the table? All those things that will help remargin that loan to make the bank feel more comfortable about the situation. So there's a wide degree here, but I would say that most of that is influenced by a company's ability to be able to be very transparent and also show projections that you have some thought in being able to get out of that predicament.
I would just add to that. I mean, in terms of covenants, and we have asset-based loans. We typically, there's a leverage covenant, a cash flow covenant. Typically, communication is absolutely key. But also keep in mind, again, on that idea of forward planning, if you get the lowest cost deal, chances are right, what does that mean? And it was just said earlier, there's a lower margin for error. So if your lender is giving you a LIBOR and 150 basis point deal, pat yourself on the back and get a great deal. But be forewarned, that means your partner has less wiggle room when you trip, right? Because they can't afford to charge off much. I'm not telling you to go out and get a 15% loan with us is the best option, but our charge-off rate on our loans which are 15% is about 3-4%, and so I got a 10% margin. That's a lot bigger margin than 2%. So, just to give you insight into how different lenders operate, that's our sweet spot. That's not Wells Fargo's sweet spot necessarily, but that's going to make a difference when it comes to tripping covenants or financial losses or unexpected, pandemics, hurricanes, all those kinds of things. There's more flexibility, and so you technically pay for it if you're going to pay a higher deal. You make those decisions today. The lowest cost deal may not be the best. It may be, it may not. Depends on stability of your cash flow, your operating environment, etc. So you've got to do a holistic judgment on that.
And I would say too, having a reliable partner is super important. Your business is not a one-time event. Your business is a series of transactions over a long period of time, and having a reliable partner along the way that can be with you is super important. And so, I mean, I literally had a deal 3 months ago that walked away from me over 0.25% interest rate. And I mean, we love this company, and the way we operate is if we do a deal for
process, a lot of times of preparing investor materials that like, okay, here's what I'm going to present to potential equity investors to sell the sizzle. And I mean, is the investor deck that I prepare to approach equity investors similar at all to what I should prepare? Or how do I prepare to approach the debt capital markets in terms of like having my ducks in a row from a due diligence and get the deal done quickly standpoint? I mean, it sounds like there's streamlined options, but in general, what does my diligence package need to look like, and how long does this process take?
Bankers typically look at historical cash flows, historical performance. When you're dealing with equity, a lot of times you're forward-looking, right? And so the things that are emphasized are a little different when you're approaching a bank about debt. On my end of things, we do some startups. We do some very early stage stuff. We do have the government guarantee behind it with the SBA that gives us some flexibility to take some more risk, and our interest rate is not, 3.5%. And so again, we're kind of in that middle space there in terms of rate that we take on more risk. So what we like to see is not only historical performance if it's there, that's the banker in us talking, but kind of like the risk-taking side of things is we'll deal with projected cash flows and whatnot, but what we're looking for is really some expertise in being able to forecast. And that's revealed a lot in the assumptions that go along with the projections. If someone just gives me 2 years of projections, I have no idea whether those are actual, like, what is the rationale behind those? We're looking for someone who can actually justify each one of those numbers all the way down the P&L. And if they can do that for us, I'm going to have a ton more confidence in that application than I am someone who just hands me, round number projections for a couple of years.
Grow 50% per year.
Yeah, sure.
Large.
Based on what? So give me the assumptions with some good detail.
I think we still want to see the debts, the same debts, because in the world, particularly in a higher risk lending pools, we are making assessment and management skills and such way beyond financial projections and financial statements. The other thing that's come to play, and I think you're going to see this continue to evolve, is open data flows between borrowers and lenders. And so we partnered with a technology company 3 years ago called Panelist, I think they pronounce it. And it's just a company that basically provides API plugins to accounting software, to all the major accounting software out there. And it allows our customers to do a data push to us off of their GL system. It's created transparency in terms of underwriting times on its head. So, and the adoption from the customer base has been more than I expected, to be honest. When we first kind of piloted this, I was like, what CFO out there is actually going to just give us a data out of the system? So, it didn't, I was like, I can't see that happening, but it did. And then it happens more and more and more, and our advisors, people that, whether it's brokers or debt advisors, et cetera, that have seen this work, are encouraging their clients to do it because it creates an amount of transparency and certainty to the outcome early in the process that we didn't previously have. And it circumvents, and it allows us also to see things that we wouldn't have seen in the traditional underwriting. For instance, we have a factoring product, which basically says we're going to stop looking at the risk of our borrowing company and start looking at the risk of their customers, their accounts receivable, right? We're going to lend based on that. But what's important? Frequency and a history of payments, right? So I know how Amazon pays because we have a bunch of Amazon receivables come through our lockbox. So I can see that, but there's a lot of other account debtors out there who don't have this. With the general ledger done, we can actually see, they pay 42 days, like clockwork, and they paid our customer for the last 2 years. I was like, that seems like a pretty good bet for me. Even if I don't know the company, I can't research or get good credit stats on it. So that kind of transparency has allowed us to take more risk as a lender. It's allowed us to support more companies with faster credit availability and things of that nature. So, but we still are going today with most of our enterprise. Understanding and having the leadership of the team tell us, this is how we make money, this is where we're going, this is how this is going to work.
quick say, I almost think, I don't know that many of us do this when we're running our business as a CFO, but I almost encourage that in so many instances, whether it's an M&A opportunity, whether it's raising debt capital or equity capital, there are due diligence checklists out there that you could go through and basically already have your stuff, like, as you think of how you're gonna file things within your file folder system or whatever, just like already do it according to how it would go into a due diligence deal room, and have your data organized like that, so that when you come to Wells Fargo or Ted, and he's like, okay, we're gonna have to put together a package for me to shop at, your package is practically already ready. And for you, is that audited financials or bust, or?
Yeah, no, good question. It all depends on the dollar amount that we're going to be lending to. I think, there's thresholds for that, but the higher the dollar amount, the more we're going to be drifting toward an audited statement. But typically it's reviewed and audited or where we play. And I would say that, having, 3 years of historical financials that have been outside reviewed or audited is a good starting place for my line of work. And I think, that it's fun to be able to look at the differences within the different providers. I would also say that as along that due diligence list, make sure you've got all your formation documents and items that will track back to the beneficial owner of that business. Your customer regulatory requirements are incredibly stiff across the banking spectrum. I think that we want to make sure that we know where the money is going and where the money flows for the business. We have to be able to demonstrate that to our regulators too. And so making sure you got that. I would also say included in that, you want to make, as you had mentioned, an equity deck. I mean, we love that stuff. I mean, it gives a good business description, it gives a good management overview, it gives a good industry overview and where you compete in the space, because you're trying to make a pitch for why it makes sense to be able to put value money into your business. And so that's whether it's debt or equity, there's money going into your business that those lenders are going to be interested in making sure they understand. And then lastly, I would also, beyond that, you're going to have additional requirements depending on the collateral that's going to be taken in my world. So information around buildings, or it had been mentioned, your AR agings and customer lists and things like that will also be relevant information, depending on the facility, but it kind of runs the gamut based off of where that runs.
We're out of time. Sorry I didn't turn it over to crowd questions, but all of these individuals are great people to know. That's why I asked them to join the panel, and so you can talk with them afterward, and hopefully